You for those updates for our first carrier update of the second hour. Right now, we're going to welcome Mike Baudendistel with us. He is our head of intermodal solutions here at FreightWaves, but also our host and writer of the Stock Out. And Mike, thank you for joining us. We're talking about now today some consumer goods prices that are now just well off of their highs. So let's talk a little bit about that.
Well, it's not so much the prices that are off of their highs. Some of the prices are still rising, though. What you see at retail, what's off of its high are the commodity prices, which should lead to potentially lower ingredient prices, and that at some point could lead to lower retail prices. So I can run through a few of these that pertain specifically to CPG. When we look at a lot of these agriculture commodities, corn's down about 15% from its high, wheat down about 30% from its high, soybeans down about 8%. Palm oil, which is actually a pretty big deal for a lot of CPG, is down about 30%. So those are all sort of well off their highs. There's still higher levels for those commodities future contracts than where they were a year ago, or even for a lot of them at the beginning of this year. But I just wanted to highlight that it's not just things like oil, copper, and lumber that are down. When we talk about lower commodities, a lot of these agriculture commodities are down as well, with growing conditions that have gotten to be a little bit more favorable. So these are signs that at least the rate of inflation is declining or moderating, assuming that this is the beginning of a trend. And so taking this to what that means for CPG companies, ingredients are about half of the CPG companies' cost of sales, in some cases more than that. And CPG companies have gone through this period since about February of last year, so almost 18 months of input costs rising faster than they had anticipated, and having to go back to retailers multiple times more frequently than usual, asking for more pricing to pass those prices along on shelves. And so in the CPG companies, because their input costs will adjust faster than those retail prices, they've experienced a tremendous amount of margin pressure, by and large, the last year and a half. And so you would think that if these lower commodity prices are part of a trend, that the CPG companies lost a lot of margin on the way up, they should gain a lot of that back on the way down. So I think you could get into a more favorable environment for CPGs. So what's also interesting is this relationship between the CPGs and the retailers has maybe gotten a little bit more contentious, because the CPG companies have gone back to them for more price increases, for retail price increases than they typically would have. And the retailers are doing, my term is auditing, basically, looking at the proposals and, going and looking at doing their own analysis on commodity costs and, input costs, and how much they really think those CPG costs are rising, to see if those price increases are justified. And the CPG companies have really sort of been rushing to pass through a lot of these steep price increases, because the perception is, as soon as commodity prices really crack, then the window's going to be over, and the retailers won't accept any more price increases from the CPGs. And if they haven't gotten their margins made whole on their margins, they're just going to have to eat it, and they're going to have to experience that margin pressure, and they're not going to make up the margins on the way down if commodity prices fall. So a lot going on there with CPGs, but that's a little bit of why these CPG companies in the last couple that have reported earnings have talked about prices rising 15%, retail prices rising 15%. This upcoming fiscal year from last. So it's still going to be a while, even if these commodity prices are a trend, that consumers seem lower prices, but in the interim could really help CPG companies.
That was going to be my exact question, was what does this mean for the consumer coming up? But I think that you just answered that right there. But let's talk a little bit about that in terms of earnings. We just finished out Q2. We should be seeing earnings start to release here sometime in the next few days to few weeks. What can we expect from some of these companies now as they're coming out of Q2? Was it still kind of a hot quarter for them, and now they're looking at the slowdown for the second half of the year?
So most of the companies, I think another big topic is elasticities, where most of the CPG companies have said, well, the elasticities are less than they typically have been. So consumers really haven't been changing their behavior all that much. So a lot of these companies that are taking 15% price increases are expecting 7 or 8% degradation in demand. So I think that's an open question. I think we're past the point where the street is surprised by the margin pressure that some of these companies have gone under. I think, really sort of the bogey now is, can CPG companies make up for any increases in cost the last, let's say, several months with higher prices that offset those cost increases on a dollar for dollar basis. And it'll be interesting to see if any of these companies address, it basically change their outlook based on the lower commodity prices, or if they just say, well, they've come down pretty quickly, not sure if it's really a trend. I mean, that's a possibility too, where they don't really adjust their outlook because the commodity prices have been so volatile, they've come down so quickly. It's not clear if it's permanently going to be lower.
And Mike, with this week being Amazon Prime Day, or going to have Amazon Prime Days, what does this mean for CPG, and how are they kind of playing in this space now?
Yeah, so Amazon has gotten to have a bigger presence in CPG. So Amazon clearly punches below its weight class in CPG, but on Prime Day, the expectation is they're going to take about 20% market share of CPG. Last year, they got about 19%. The year before that, it was about 18%. So they seem to sort of gradually be expanding their presence where CPG is something you buy on Prime Day. Sort of ordinarily, when it's not a Prime Day, Amazon has about 4 or 5% share of CPG. So they're still really sort of punching below their weight class in terms of CPG. But Amazon is getting to be a bigger player there. I think there's a large demographic that's realizing that going to a store for something that isn't perishable, or maybe even something that is perishable, just really isn't worth their time. Particularly these Prime members. So Amazon's offering more sort of staples there. You see Pepsi making it a big part of their push. So a lot of their products are on the Prime, whether it's the oatmeal or the snacks. So I think that's pretty significant. And then also I really think the smaller brands have a chance to compete against the bigger brands on Amazon. Either by buying ad space, or you're paying to have their products listed higher. Almost no one goes past the second page. But really, if they can harness the power of targeted ads and knowing who you're targeting, because a lot of these sort of niche CPG companies, they have a very specific demographic in mind. So getting their product in front of those consumers with an algorithm based on other internet behavior, I think can be pretty powerful online.
100%. All right, Mike, thank you for joining us this morning. Great to have you as always. We will talk to you again soon. Right now, we're going to take a look at some top stories making headlines on freightwaves.com.